I would like to say good afternoon to our European clients and good morning to all our overseas clients, and welcome to the Arctic Securities E&P and Oil Services webinar. My name is Anders Berglund, and I will be moderating today's session, a session that is expected to last approximately 45 minutes, including a Q&A session that we will take after the formal presentation. Today's speakers are our senior oil analyst, Ole Rikard Hammer. We have our senior E&P equity analyst, Daniel Stenslet, and finally, our senior oil service analyst, Lukas Dahl. If you have any questions, please use the question bar at the right side on your Teams template, and we will address these questions after the formal presentation. We're starting out the session with our senior oil analyst, Ole Rikard Hammer. Ole Rikard, with declining inventories, global economy recovering, multiple years with E&P spending reduction, I suspect a significant increase in the global feed depletion rate. Are we in the perfect storm right now, and will we potentially see a three-digit oil price in the near term?
Thank you, Anders, for that good introduction. Certainly, several factors are pointing in that direction. Remains to be seen how far we can go, but we have upgraded our view on the oil market, which already was a relatively optimistic view. We see the fundamentals tightening, and we see them improving further, and hence we believe that tightness that we're seeing in the market is not transitory, and that we have an oil price cycle which is set for further improvements as we go forward. I'll take you through the main points behind our updates. First and foremost, when we look at some key metrics in the market, inventories and spare capacity, they have both come down from very high levels to now quite low levels in a very quick amount of time, and are pressuring on those levels. That is mainly a result of developments on the fundamental side. We see oil demand improving and going stronger, led by a strong world economy. And we believe that global production, even though it's rising as we speak, is facing several headwinds, and that the growth risks are on the downside. So in this market context, we believe that coal and OPEC oil is heading higher, and its spare capacity is heading lower, notably from the second half of this year and onwards. We've upgraded our price views. We had a $80 view for quite some time. We now, for the current year on Brent, expect $85 as an average price. For next year, we had a $70 to $90 range. We now expect that to be $90, so that the point estimate is right at the high end, or top end of that range. And for 2024, which is 2 to 3 years out, we have a new range of $80 to $110. So the takeaway from this is that we think oil market is in a cyclical upswing. We know from previously that oil markets tend to swing and that cycles tend to last in 8 to 10 years duration. We're not saying that prices are going to go higher up until 2030, but we certainly think that this is a cycle which still has a good time ahead of it. We're maintaining our long-term $70 forecast for the very same reasons. We expect the oil prices to remain cyclical. Hence, we're now set for a period of higher than normal prices. We think that will eventually give way to the next downturn as things go. But that's too far ahead to worry about, in our opinion, and our focus now is on the cyclical improvement and what's driving it. Let's start on the demand side and look at some of the key metrics, as I said, which have produced this market tightness. We got two graphs here. On the left-hand side, we got oil inventories plotted against the oil price, inventories measured in days of forward cover. And we're seeing inventories, after hitting a record high in 2020, have come down quite quickly, and they're now moving below 60 days of forward cover, which is the red diagonal line horizontal line on this graph. Previously, when inventories have gone below this 60-day threshold, the oil price has changed character, typically starting to behave more or no longer linearly, but more exponentially as the market becomes a lot more sensitive. So inventories are now into that zone, and we think they are going to head lower. But the important point of the observation is that we have crossed the red line, so to speak, which highlights increased market sensitivity. Typically, another key metric in measuring market tightness, on the right-hand side, we got spare capacity within OPEC, including Russia. This spare capacity level went through the roof, as it were, back in the spring of 2020, when it exceeded 10 million barrels per day for a while. So this is spare capacity which can be brought to the market within 2 to 3 months. So very little work is needed. We're seeing then, after a period of very high spare capacity, it has come down quite consistently. And we're now entering this blue range marked out on the graph, which is between 2 and 5 million barrels per day. And again, this is typically a level where the market starts to endure some stress, depending obviously on also other factors. But again, once we hit this level, prices tend to become more volatile. The green bars on this graph is how spare capacity will develop as we go forward, assuming OPEC will continue to increase production. And we can see that within a few months, we are right in the middle and heading towards the lower end of that graph. Couple of comments. Most of the decrease in spare capacity is a result of an increase in oil production, but some of it is also down to lower actual capacity. We see a couple of important OPEC countries, Nigeria and Angola, are having problems meeting their production. And we've also seen Russian production levels of late flattening out when they should be increasing. So there's some question on the actual capacity levels. Of the 5 million barrels per day that are here, about half of it sits with Saudi Arabia. The rest is with Iraq and the Emirates and Kuwait. So it's concentrated on quite few hands. We have kept the Iran figures out of this graph of about 1 to maybe 1.5 million barrels per day, as a return of Iran exports, in our view, is being pushed further out in time. But that's important. So at 5 million barrels per day, and 60 days of forward cover, we are entering a stress zone for the oil market. Then let's look at the drivers here. World economy and oil demand definitely is part of this market improvement. And we've had the confirmation, in our view, over the last 2 years that the world economy definitely remains the key driver of oil demand. As you can see from the graph here, the correlation remains quite tight. World economic growth is set to remain above trend the next 2 years on the IMF forecasts, and we think that is the case for oil demand as well. Economy has strong growth into 2022, and we see that the Omicron effects, which the market had a lot of fears about, understandably so, before Christmas, have proved to be quite moderate so far, and really not any clear effects on oil demand at all. We're seeing economic policies being extremely stimulative for oil demand. They may be tightened or likely to be tightened later this year, but still will remain stimulative, just not extremely so. In our view, the price levels that the market is seeing now are not high enough to moderate demand in their own right. So we think the world economy clearly can live with current price levels and higher. So we expect the demand growth to be around 4 million barrels per day for the current year. That's higher than the IEA. We expect the IEA to upgrade its view, and we expect a 1.5% growth next year, which still would be above the pre-COVID trend. Post-COVID normalization, including travel, are set to be a key driving force for demand this year. One particular point we're focused on is which countries are driving this demand growth. And as we can see from this graph, the blue bars show the OECD countries, the green bars show the non-OECD countries. And what's quite peculiar is that it's the OECD countries which are driving the recovery in demand over the past 9 months, while the non-OECD countries are lagging. In our view, this is due to the vaccine differences in vaccine levels, which we believe is set to close gradually later through the year as improvements reach and volumes reach the non-OECD countries. And consequently, there is a catch-up potential here. We're in particularly focused on China. Chinese demand has been growing with the economy. Imports from abroad have not. They've been declining, so there's a substantial inventory draw in China, in our view, during 2021. We think that period is coming to an end with the New Year celebrations and holidays next month and the Winter Olympics, and we think China will become more growth focused as we get through these events and later in the year. So a stronger catch-up potential for the non-OECD countries is the reason why we see oil demand doing better than the IEA in our forecast. Switch now to the supply side. A lot of similarities with demand in that it's recovering, but also some key differences. What we got on this graph are oil supply or oil production numbers change year over year for the non-OPEC countries without Russia, which is now more a part of OPEC. We're seeing that 2022 is expected to be a year of quite strong growth. We can see it in the numbers already. Production is heading higher, but it's not going to be as high as what we saw in 2017 and 2018, and we see it moderating already next year. So we think that it's a much more modest growth cycle than what we saw in 2017 to 2019. There are two reasons for this. Number one, global capex levels peaked in 2014, have been heading lower since, even though there's been a recovery last year and a further recovery this year. There's still nearly 50% down on the peak in 2015. That has consequences for the growth opportunities going forward, given that actual production is higher now than it was in 2014. Looking at the countries which can contribute to supply growth, it's Brazil, Norway, Canada, maybe also Guyana. But none of these countries have the potential to really surprise the market, as the increments will be typically 100,000 barrels per day per year, or maybe for one or two of them up towards 200,000. The only country which can really impact the supply picture, of course, is US shale. And you can see from the graph here that we expect much more moderate growth in US shale production as we go forward. There's a couple of reasons for that. One is what's happened on the industrial side in terms of consolidation and a more profit-oriented focus. But there's also some key, I would say, market developments. What we're focusing on here is the significant decrease in inputs into the US shale sector. Left-hand graph shows the volume of wells drilled. On the blue bars, as you can see, they are down about 70% since the peaks of 2018 to 2019. Given the short cycle nature of US shale, with most of the wells depleting within around 3 to 4 years, it means you have to drill a lot to ensure that supply comes on stream. So this 70% reduction, we think, has consequences for the growth opportunities as we go ahead. Looking at the green bars, we see that the actual well completions, on the other hand, have not declined as much as particularly the last year. That means companies have been tapping well inventories from wells that were drilled previously but not completed. That is, in our view, a source of short-term growth only. On the right-hand side, we got shale production levels. And I want to focus on the brown dotted line, which is our estimate of what shale production would be if there were no contributions from the DUCs. We put it at 0.3 to 0.5 million barrels per day lower. And if you look at the EIA's forecast, which is for maybe 600,000 barrels per day growth in shale production in 2022, we think it's going to be a challenge to reach that forecast if you assume that the contribution from the DUCs, which have been reduced by about 50%, is going to be smaller. And we note that at least the stock listed part of the US shale sector continues to focus on very cautious investment spending as we go forward, and more preoccupied with paying dividends and doing share buybacks. So in that environment, and looking at the current levels of drilling and rig activity, we think there needs to be a significant increase from current levels to have a chance to reach that target. And so far, we do not see that happening. So our forecast is somewhat lower. We don't question that there's going to be growth in US shale, but we think the risks are on the downside relative to the EIA forecast. So if we take this back onto the macro level once again, what we look at here again is the non-OPEC supply projections going a bit further out. 2022, as we said, is set to be a year of decent growth, maybe about 3% for the sector. Then we see 2023 already moderating down to around 1 million barrels per day. And from then on, the production increases are set to converge on becoming maybe what you can call marginal as they get lower and lower. That's when you start to get hit by the real effect of this slump in capex, which has lasted for a long period and is now increasingly unable to deal with depletion rates. The effect on the market depends, of course, what happens to demand. Our view here is that demand, while certainly not going to increase by 3 to 4 million barrels per day on a permanent basis, we believe that the 1 million barrel per day increase is going to be proved to be quite sticky. So you could look at this graph and see that there is a gap opening up between demand and supply, which spells higher pricing power to OPEC. And that's what's behind fundamentally our higher oil price forecast. I want to finish off with one graph. Obviously, you have to talk about the unexpected when you talk about the oil market. We know that the prices tend to be are sensitive to geopolitical events and supply disruptions. This sensitivity grows, obviously, the tighter the market becomes. We are, of course, we don't know anything about what's going to happen about unexpected events in the coming year, but certainly Iran, which has been a factor in the market for the past decade, could remain so. And we're also seeing Russia and other local countries, and named here the FSU, becoming potentially more of a disruptive factor in the oil market as it's been in natural gas. So the message from us is that we see a very strong fundamental situation, which has arrived faster than almost anyone could have expected. And we see demand continuing to improve while supply is facing constraints. And we think the geopolitical risks probably are on the upside. So in that environment, we see oil prices continuing to improve cyclically, and that's behind our forecast upgrade. Thank you.
Thank you very much, Rikard. I think I saw $100 a barrel figure in there somewhere, but very good. Our next presenter today is Arctic's senior E&P equity analyst, Daniel Stenslet. He will give us his top picks in the Arctic E&P universe. Daniel, headline in today's financial paper was, "Today everyone wants E&P stocks." I guess they have all got a sneak peek to Ole Rikard's presentation. But with his backdrop and the potential for a $100 a barrel, I guess we can buy all the E&P stocks out there?
More or less, yes. That's the short and sweet answer. And I can definitely see why investors are looking into the space now. I'm starting off with showing our coverage universe in the E&P sector, divided into two categories: the large caps and the mid to small cap names on the right side. And you can see a lot of buy recommendations. We generally see more upside on the names to the right. But we are also we recently upgraded Equinor and Lundin also to buy. So all the names on the right and on the left side are also on buy, and that is because we are more bullish than consensus on the oil price. So I'll briefly start by showing what we've done since last time with commodity prices. Oil to the left, you see the development in our nominal Brent forecasts, where we especially have increased 2023 and 24 estimates from 70 to 90, and also the European forward gas prices to the right, how they have evolved over the past year, and notably over the last quarter. The market is pricing in a sustained high level throughout the 22 and also including first quarter 23. So that is what we have used, for instance, in Equinor, where we increased the target quite substantially. So I'll continue with the large caps first, starting off with Equinor, and I'll continue with a sector screening exercise for the companies that I mentioned on the right. So starting with Equinor, you see on the graph towards left how consensus EBIT estimates have evolved throughout 2021, and represented with the dots towards right on that chart, how our estimates are stacking up compared to consensus. And you can see that we are notably above both on 2022 and 23. Mainly because we are more bullish on the oil price, but also because we have used the most recent forward gas price levels. So upside versus consensus on the estimates when it comes to multiples. On the graph down to the right, I'm showing you how the sector has been, or the sector pricing has evolved from an EV to EBIT viewpoint, and that we're approaching trough levels, what we've seen over the past 7-8 years, which in our view reflects that the market is pricing in the current commodity price environment to be extreme, or to be peak earnings. And while we can to some extent acknowledge that, we think that these earnings levels are not going to drop off quickly, but instead, as you can see, 2023 and 2022 is not that different. We think we believe in the high price environment, and even though gas prices are likely to drop off to some extent, it will be partly compensated by higher oil prices on our numbers. So we think there's upside to the multiple also as a fact, or driven by a fairly or this level that we're seeing is going to be the norm for a couple of years. And when it comes to setting or using a multiple to set the target price, on the upper right, I'm showing you how the sector has been priced on a price to earnings ratio in what I think is the most representative time window from 2016 to 2019. The sector was priced at a PE of 13, and Equinor being in the middle of the field of those players, so also price to earnings 13 for Equinor specifically. And what we're of course aware of is that we do not want to apply historical average over the cycle multiple on what we think is somewhat higher than average earnings. So in our Equinor sum of the part, we've used a PE multiple of 8.5, and also applied that to our 2023 earnings instead of 22, because the 22 figures will be influenced by high or elevated gas prices throughout the whole year. So we're instead looking in towards 23, and have used a multiple that is significantly lower than the average over the cycle over the past 7-8 years in the most representative time window. So that takes us to a sum of the part of 294, which is also the basis for the target that we just updated on Equinor early last week. So moving then to Aker BP and Lundin, I'm showing some pro forma estimates on the merged entity, how that would look. We upped our target in Aker BP based on a NAV net asset value calculation, and increased our target in Lundin quite significantly from 370 to 430 as a consequence of the exchange ratio between those two shares being locked in, given that the merger is or goes through. So perhaps most interestingly showing on this set of charts or on this slide is to show the dividend outlook for the combined company. And the 2022 figures are more or less established. The company gave some clear guidance on the dividend level for 2022, and based on their policy, are promising to increase that dividend level by at least 5% annually all the way until 2028, given that given a Brent price of $40 or above. And just to show the upside potential, I think that's well visualized when you see that in conjunction with the net debt development on the lower right graph, where you can see that given that Aker BP and Lundin will invest in their combined portfolio and deliver on the dividend figures that I show on the upper right graph, you will see the development in net debt that you see down to the right, and which implies that the company will approach a net cash territory in 2028 down to a Brent price of $50. So that shows that there's a lot of upside to the dividend figures that I have showed on this slide, with also attractive yields going forward. On to the mid to small cap names. On this slide, I'm trying to compare the cash flow outlook in the various companies compared to how they're currently priced. So what I'm showing is the sum of our free cash flow estimates given our updated price deck and given the development plans of the various companies. So we take the sum of the free cash flow estimates until the end of 2025, so 4 years and 1 quarter, and divide that by the current enterprise value of the various companies. And by doing that, we get a ratio or a percentage figure that you see on the slide. So quite interestingly, a lot of these companies are set to generate close to or above their current enterprise value in free cash flow in that relatively short time period. And you can see also how that compares to some of the large names like Aker BP and Lundin in the same time period. So definitely attractive in our point of view. And one reason behind that pricing could be, for instance, that it could be justified if their production rate was really, or their production outlook was very, had to be in a strong decline, or if the reserve life was at a low level. And what I'm showing you on this graph is an additional parameter, which is the dots, which again are linked to the axis on the right side. And you can see. And those dots represent the reserve life of the various companies, and you can see that most of them have a reserve life of 10 years or more. So the way you should read the graph is that okay, most companies will generate a very high fraction of their enterprise value by 2025, but if you add or if you subtract 4 years from that from those dots, you still see that most companies have way more than 50% of their resources still available by that point in time. Again, representing that there's a lot of additional value in the companies by then. So it shows the attractiveness in pricing from a different angle than, for instance, a price to NAV ratio. And that analysis is fairly simple, so I added 2 more parameters to make it a bit more interesting or a bit more nuanced. So what I've added here are 2 additional parameters. You see a color behind each bar representing, or a dark color is representing higher capex or higher estimate risk, And again, a slightly lighter color is representing the opposite, less capex and less estimate risk. And then also showing, or also added a red circle around some company names. The red circle is representing whether the company is in dividend position today or whether it will be in dividend position by the end of the year. So based on these 4 parameters that I'm showing here, we think that the companies that are representing or offering best risk reward in the current environment are Panoro, Africa Oil, BW Energy, Gulf Keystone, and IPC. And we're also highlighting OKEA and DNO as companies that offer really good risk reward and are deserving an honorable mention in this analysis. So that was my main points. Also showing a list of expected triggers in each company that you can study more in detail later on if you'd like. So that was my section, and yes, Anders, you can buy more or less them all.
Thank you very much, Daniel, for a very good presentation. Our next speaker is Arctic Senior Oil Services Equity Analyst Lucas Dahl, who has recently joined us here at Arctic. Welcome. We're happy to have you on board and strengthening our team.
Thank you, Anders.
He will give us his perspectives on the oil services sector and his top picks. So, Lucas, I guess the Bible was right. Following 7 good years, we will have 7 bad years, and I think we can fairly say it's been 7 really bad years in oil services. We have 7 years with annual decline in E&P spending that has resulted in industry-wide financial restructuring. We have seen dramatic cost reductions. We have seen a massive fleet scrapping to balance supply and demand. But I guess with Ole Rikard's positive oil price prediction and the solid cash flow generation from the E&P sectors, from the E&P sector that will generate, I guess the $1 million question: will investors go bargain hunting in the oil service sectors today?
Yeah, that's a good question, Anders, and I'll try to answer that. And to your point of 7 difficult years, I mean, I have only taken this as a starting point, looking at the last 2 years, and we can see on the chart that the best performer has been the S&P 500, which is the broader market, and followed by the oil price, then the oil companies, and at the very bottom we have the US OSX index, and then the Norwegian oil service index being the biggest underperformer. So yes, it's been difficult, and the underperformance in the Norwegian space obviously has to do with a lot of exposure towards offshore, and many of the companies owning the assets being capital heavy. That has been a very unpopular proposition for investors over the last 2 years. So as a starting point, we have 2 years of significant underperformance, and the question is whether what we are seeing on the oil price and the levels that Ole Rikard is predicting going forward is going to change some of the sentiment surrounding these shares. And I remember from 2009, following the financial crisis, US CEO saying that $70 a barrel solves a lot of problems, and I think it still applies today. So bearing in mind that the E&P spending levels are down more than a half from the peak in 2013 and 14. Looking at the changes year on year, we see that in 2022 we are looking at approximately 7% E&P spending growth offshore, and even though it doesn't seem sort of very high, I think that it is the highest increase since 2013. Obviously, using the old regression line where you would have delta oil price and delta E&P spending on the axis would have resulted in a higher bar. However, in today's world, there is a much more uncertainty for the oil companies regarding the regulatory environment. They have a lot of options where to allocate their capex, obviously between oil and gas and renewables. And we have also seen an increased activism in these companies. But 7% is a good starting point. Another thing to notice when it comes to offshore spending is of course the fact that 80% of offshore capex is carried out by two major groups, and those are the national oil companies and the majors. Interestingly, those two groups were investing around the same amount of money 10 years ago. This year, the NOCs are likely to spend 50% more than the majors. So the NOCs are actually set to increase their spending offshore by 20%, whereas the majors continue their decline, expected to be down 8% in 2022. And that, of course, boils down to that being a publicly listed oil company today, I guess that the path from generated capex down to allocating it to another oil and gas project is not a straight line as it used to be 10 years ago. So looking at sort of the Norwegian oil service space in 2021 and taking some of the shares which have a certain market cap and are sort of considered investable by the general public, we see that there has been a big discrepancy in performance, with Aker Solutions being the best performer, followed by Odfjell Drilling, and Subsea 7 and TGS and OPEC were at the bottom of that pack. Looking at the offshore exploration, the same picture applies here as for the overall offshore spending. Spending is down more than 50% compared to the peak levels in 2013 and 14. The share of budgets allocated to exploration is maybe 15-17%. It used to be 20 to 25. So yes, there is a different world out today. But on the delta, we are still looking at approximately 20% growth in 2022 for the exploration budgets. And that's a meaningful increase after many years of decline, basically ever since 2015. And those major cuts in exploration are starting to sort of show in the accounting of the oil costs, because 2021 looks to become the year where there have been the fewest, or we have discovered the lowest volume of oil and gas in 75 years. So obviously, with headlines like that and a generally tighter oil market, this sort of begs the question whether we will sort of revisit the theme that the world needs to look for more oil. And that would be anything else equal delta positive for the service companies. The service company sort of exposed to this to the exploration theme is here in Norway's TGS and OPEC. We have seen the revenues decline significantly and trough in 2021. We have the company has come out with an update regarding Q4 just Monday last week, and despite the numbers being only slightly better than expectations and the outlook being just a little bit less negative than in the previous 6 to 8 quarters, investors were quick rewarding the company with the double-digit share price performance. So I think that after 2 years of estimates being cut, we have sort of reached the bottom. Looking at 22 and assuming 20% growth in sales, we are sort of moving up, although low in the historical context. And then the question is, in 2023, here in our estimates, we have sort of applied another 20% growth. in the top line, and where is it going to bring us in terms of pricing? And we see that the 20% growth in 2023 returns approximately 15 times price earnings, and the question is whether that is interesting enough for investors or not. We would need to sort of see a 30% growth in the top line to get to a 10-time price earnings ratio. So I guess that for the company, which used to be sort of a proxy of being an oil service bet, the question really is whether the business model they have is challenged or whether it's sort of broken. And time will show. They are trying to develop a renewable leg as well. Haven't sort of been able to add a meaningful position in there yet. But for the short term, we think that given the underperformance TGS has had over the last 2 years, and the stock has been relatively flat during that time span, it offers a good risk reward over the next 3 to 6 months. Moving on to the sort of another segment within the universe, the engineering and subsea players. They are obviously dependent on oil companies sanctioning and FIDing new projects. 2020 brought a collapse in that activity, basically a full standstill. 2021 was a year of recovery. 2022 is going to be relatively the same before a major pickup being anticipated in 2023, with oil companies basically coming down from the fence after sitting on it for 2 years. Norway has been a bright spot, driven by the sort of tax incentives offered by the government post the COVID outbreak. So in Norway, 2022 and 2023 look to be extremely high years in terms of new contract awards. And one company that has been benefiting very well from the trend and has been the best performer among our shares last year has been Aker Solutions, which has sort of presented ambitious targets. They are positioning the company towards the energy transition, targeting more than a third of their revenue coming from the renewables by 2025. And in that process, also generating about 1 billion a year in free cash flow, some of which we believe could find their way back to the investors in the form of dividends. So they are in a good position to upgrade their 2022 guidance, we believe, when they report the second week of February, and also come with a dividend proposal, which would be a feast for a company in this space. Another company which has had a different fate than Ocker was Subsea 7. Even though they are very similar, both companies are sort of coming out of a very significant downturn with almost net cash position. Both of them have achieved to develop a renewable leg, which we think is a prerequisite for an oil service company to be sort of able to navigate through the energy transition towards the future. Subsea has been a big underperformer compared to Akso. And one of the major things, obviously, is that they do own the vessels. They do own offshore steel. They are capital heavy. And as mentioned before, that's not been a popular choice for the investors. Also, in terms of earnings, the company has guided on 2022 to be relatively flat on EBITDA compared to 2021. So we sort of have to wait a little longer until 2023 before we see a meaningful increase in earnings. That said, the share is trading at around 25-30% discount on EBITDA compared to the historical average, which we think is attractive. Also, bearing in mind that 2022, 2023 are going to be good years in terms of order intake and announcement of new projects. And hence, we think coming from a position of underperformance, the stock should benefit from that. Quickly wrapping up with the drilling universe, that has been very hardly hit, and it's been almost an industry-wide restructuring exercise going on for many years. I think for the shares going forward, the key is whether investors will buy into the consolidation theme that has been around for a while, and we have seen some consolidation happening already. On that note, it is interesting that John Fredriksen is taking a stake in Valaris. You would think that heading into an upturn, you would be sort of looking for a position with very high gearing levels. Nevertheless, Valaris, which has been recently restructured, is sort of his choice, and we think it has to do with the fact that not being able to exactly time when the market is going to recover. It feels much safer to sit with a company that has a decent balance sheet, that is not going to run out of money if there is a 1 or 2 year delay in terms of the recovery, and that offers meaningful upside at rig value levels anywhere between $200 to $400 million. So moving within that range, safe bets are still offering significant upside. We would need to sort of move back to the old levels where replacement costs were anywhere between $500-600 million rig before the gearing effect in Transocean has a meaningful impact on the equity upside. So in Norway, Odfjell Drilling would fit the bill of Valaris and Noble in terms of being stable, having visibility, and having a good balance sheet. Finally, we just have one slide on Ocker that obviously offers a discounted exposure towards our E&P topic, Aker BP, and partly towards also Aker Solutions. Company has been very active in terms of executing and structuring deals throughout 2021. It's been rewarded for that with the decrease in the discount to NAV, which is now around 12-13%. However, at our target price of Aker BP at 370, that discount would go up to 20-24%, and that would of course be above the 5-year average. So summing up, I guess that having a basket of companies like TGS, Subsea, and Oxo is a good way sort of to position yourself for what we think will be sort of an interesting 6 to 12 months.
Thank you very much, Lucas. And I would like to invite Daniel and Ole Rikard to join the Q&A session. And I also would like to remind the audience to post questions. I think I will start out with a question to Lucas at the end of the presentation, and that is, what do you see as the biggest challenge for the investors to invest in the oil services industry? Is it the question of that there's only one cycle left? Are we heading for multiple cycles? And how will that impact the valuation, you think?
Well, I think the biggest sort of invest in that theme is I think that until now they have been willing to take on that exposure by investing in the E&Ps, and they have been well rewarded for that. And I think the question is whether you would sort of continue to looking for companies where the risk reward might be even greater, but at the same time you're sort of moving away from where the cash comes in, because as I sort of mentioned today, generating a lot of cash, an oil company has plenty of more options what to do with it than what we maybe were used to 10 years ago. They can spend it on buybacks, they can spend it on dividends, they can spend it on renewables. So I guess that the main uncertainty is whether that cash flow that is being generated is going to flow back to these sort of oil and gas projects and to the benefit of the oil service companies.
To pick up on that, Daniel, in your universe, go to the dividend and the share buybacks, or will Luke as a sector also benefit from this?
Well, it will be a mix for sure. There's such a great pool of projects just getting so profitable in the current market that I would be surprised to not see increased spending. But the companies have the luxury of still being a bit picky and choosing the projects with the best break evens, etc. But some spending growth would be very strange not to see.
Are there any regional differences? Do you see a move towards the U.S. Gulf of Mexico, etc., or shallow versus ultra deep water, or offshore versus onshore?
Well, in the companies or for the companies I cover, they are more or less situated in the region. They have their own space, they have their set of projects in that region. So it's not that much of diversifying into a completely new region. But what you can see generally is that the North Sea activity level has been quite high through the past years. And I think it's more likely that we'll see a stronger activity increase in other regions.
And just a final question to you, Daniel, also on this topic. Do you see the spending going toward exploration or development, or will they be forced to do more exploration, you think?
I think still there's a lot of undeveloped, attractive development projects. So it's not so much a question about having sufficiently large fields, but deciding to actually develop them. So I think in that sense, I would be more bullish on names offering short cycle cash flow projects than long lead time exploration.
And to you, Rikard, I guess it's a recurring question to you. Greatest downside risk to oil demand estimate, and potentially what could be the upside risk to your thesis?
Understandable question, given that we have quite an upbeat view. I think on the downside, obviously another great outbreak or some kind of variant in China or Asia is potentially one factor which could upend the demand outlook. On the fundamental side, we think also China is a key where China is a key fundamentally because we see some strains developing in the property market, and after a long period of stimulation, there is a risk that it's hard to calibrate the size of the downside risks, but I think also there are upside risks because we have such a huge source of bottled up demand following 2 years of shutdowns. I don't think any analyst really can model that. So I just looking at what happened after the financial crisis, end year demand, the reality was about twice the start of the year forecast increase. So there's definitely a lot of interplay between different factors which could offer us some upside as we hopefully get out of the COVID situation.
And I guess what we learned in the historically is that never underestimate the US shale players. They are quick to cut costs. They're quick to reduce their costs. Do you see any risk at all that they could be the let's say the next party ruiners in the horizon?
Yeah, for sure the risk is there, and that's what we keep thinking about because of the history of quick surprises and quick turnarounds. But I do think the situation is different. I think the capital markets are very different for the US. We know that the capital they offer. I think the new thing, which the shale players are saying themselves, is that access to bank capital also has become much more challenging in the US as the banks there follow Europe. So I think with a significant part of the industry still being restrained, I think the US shale industry is going to remain reactive, i.e. production will go up because the market needs it. I don't see it turning around into a free fall, sort of proactive for quite some time still. So I believe risks, oversupply risks are low in 2022 because there are lead times involved.
And an overarching theme, in the energy industry is, the energy transition and transition to more greener production. How do you see, Lucas, the oil service company navigate through this energy transition?
Well, I think that they have had a hard start to begin with, because they were sort of put onto this ONG umbrella, and the light was turned off. But I think that if we sort of think about it in a bit bigger perspective, a lot of these companies have been dealing with the oil and gas for 40, 50 years. They have a lot of competence, they have a lot of experience. And I guess that using that competence and experience on something else than oil and gas, whether it's hydrogen, ammonia, wind cables, etc., is actually a very good starting point. So I think that if you have a company that is able and willing to change and adapt, it probably faces a great future, given what there is to come in the energy transition. And I think, that maybe 10 years, 5-10 years from now, we won't be referring to these companies as oil service companies. We will be referring to them as energy service companies or something like that.
Twist the words.
I think that that view may not be sort of
And Daniel, looking at one of your companies, Equinor, has really been stepping on the pedal on the green side. For the ESG motivated investors that's been investing in Equinor for the green side, are any disinvestment risks in that sense? Are there any risk associated to that portfolio going forward? You see on the valuation side?
The valuation of the green portfolio in Equinor?
Exactly.
Yeah, of course it is. Those return figures are at a very low level. They're guiding at typically 4 to 6% real levered return. So the margin, given some sort of capex exceedance, etc., is very low. So that's definitely a risk. From the overall broader Equinor investment case point of view, a few dollars up or down on the oil price is having more impact than some reduction in renewable returns. So that's the main driver. But yes, the risk on the green side and the valuation of that part of the company, that's definitely there.
And in order to mitigate that risk, do you see anything in the horizon that they're, let's say, divesting the green initiative out of the old Equinor?
That's certainly something that they are considering, I would expect. And there are reasons to do it, reasons against doing it. I think it's something that we could discuss for a long time. And it's been an open debate for a long time already. I don't see it as a key catalyst at this point. I think personally that it's something that would trigger some repricing, but it's not a huge catalyst, as I said. I don't think Equinor investors have been disappointed by the share price development, and I wouldn't say that you're not. I would expect there to be some renewable contribution in the share already.
Okay. Ole Rikard, stepping a little bit out on the geopolitical scene here. That's a tough one. Either way, a sustained oil price rally, will that tempt the US to speed up and soften the negotiation with Iran? Is that, you have any views on that?
Well, we've seen that the U.S. over the past year has signaled that it is sensitive to rising oil prices. I do think that getting to terms with Iran is going to be quite difficult because resistance against Iran runs very deep through the U.S. Congress. And on the Iranian side, the fronts have hardened between the U.S. and Iran, and on the Iranian side, I think it's hard to see them making any big concessions. So I think that this whole period of negotiations between the U.S. and Iran will continue to play out. Eventually, the Iran oil will come to the market, but in our view, probably not before the market needs it. And I think the risk of the U.S. really stepping up overtures towards Iran is low to moderate. It's very difficult versus the domestic oil lobby as well. So I think they will actually try to get on better terms with Saudi Arabia before that to elicit more supply.
Well, staying in the same region, I guess, never a webcast without the tanker question to Ole Rikard. With the rising oil price and demand, will Saudi and OPEC step up and increase the production again, giving positive spin to the tanker market and then the tanker companies?
Well, I think all arrows are lined up for the tanker market because volume is increasing. OPEC is already raising production. Demand is going up. I think the big issue has been stock draws in China, which has limited the impact of demand from Asia. And the second issue is on the tanker side. We've seen very few less vessels leave the fleet for scrapping or layup or anything else because of the poor market. And that means the tanker fleet has expanded. So that has raised the bar for that recovery. I think the recovery is coming because demand is improving and the order book is moderate. But the tankers could also do something about the capacity issue.
Thank you very much, and I think that's all we can that we'll reach today. We have exceeded our limit of an hour by 10 minutes. We'll put that on the account of IT failures. That's how it is. The first time in a new studio. Thank everyone for listening in. We recommend you to reach out to our panelists, Ole Rikard, Daniel, and Lucas, if you have further questions, and we look forward to see you next time. Thank you very much.